And I love this definition because I think it makes perfect sense to anybody who already knows what a mutual fund is. And it's a little bit convoluted if you don't know what a mutual fund is, which makes the definition fairly pointless. But a mutual fund is an investment vehicle that is made up of a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and similar assets. Mutual funds are operated by money managers who invest the fund's capital and attempt to produce capital gains and income for the fund's investors. Makes perfect sense, right? Seeing some blank stares. We'll come back to that in just a second. Before we do that, I want to go on to this slide, which kind of lays out the risk versus return. Stocks are risky investments, and so the return is typically higher over an extended period of time. Bonds are safer, but the return is a little lower. CDs, what you get from the banks, treasury bills, money market, what Dave Ramsey told you to save your emergency fund in, those are really safe. You're not going to lose money there, but you're also not going to make a whole lot. But I want to do one more think, pair, share here with stocks, and I want you to describe why investing in a stock is a risky investment. So the question again is, why is it risky to invest in a stock or in stocks? All right, go ahead and talk with your neighbor for a minute.
If the stock goes down, then you have to wait a while for everyone to add what you guys decided that you need. And
slide in and join up with them.
My mind can't comprehend the deepness of the conversation.
All right. I think a lot of your groups have kind of come to a conclusion. I'm going to pick on your group. One of the three of you. Why is it risky to invest in stocks?
You don't know if the company will do well. You could buy stocks in it and then the company totally crash and be like a really sucky company and then sell it for less than you bought it for.
That is exactly right. So let's go back to my example of Matt's company. If I bought stock in Matt's company, well, if I didn't do my research and turns out he makes really, really crappy net books and the company is just not going to succeed, well, I paid $10 a share for it. If his company goes out of business, how much do you think my shares are worth? Yeah, virtually nothing. That's really the risk with investing in a single company. So what then would be the best way to mitigate that risk? What's the best way to ensure that that doesn't happen to you? Matt?
Research and invest a little bits of money in like a couple different successful companies.
So, yes, on both accounts. Research the companies that you would invest in, and spread your money out between more than one company. That way, if one does poorly and one does well, you're fine. At least all your money wasn't in one company. How many of you, on a daily basis, go home and read the Wall Street Journal? How many of you check Market Watch? How many of you read financial reports from various companies? I didn't think so. How many of you are independently wealthy and are able to buy a whole ton of different stocks?
Oh yeah. No. I don't know.
Again, probably none of you. But what if we decided to pool our money together? So you give $50 to our fund, another $50. I give $50. I probably put like $1,000 in because I'm so fabulously wealthy. Yeah, exactly.
When you're a teacher,
Yeah, teachers, we make bank.
Especially Christian private schools.
Especially Christian private schools.
I mean, obviously, you're
Now you know.
You're a millionaire.
All right, so you know, instead of just us, maybe I'll extend that pool and say everybody at Christian Hire, everybody in the U.S. or everybody in the world can add money to this fund, and we'll just pool all of our money together, and then we will hire somebody. We will hire somebody to take that money and invest it for us. Now we're going to have to pay him something, or her something. But that person can then spend their full time analyzing companies, making sure they're good investments, moving money if a company's looking bad. Well, all we've really done then is created a mutual fund. So that mutual fund, again, is an investment vehicle. It's a way for you and me to invest, made up of a pool of money collected from a lot of different investors. So we all invest it together. And so even if I only have $50 in that fund, it's really being split up between Walmart, Google, Sears, ExxonMobil, British Petroleum, I don't know, a whole multitude of companies. And if one of them does poorly, it's okay because the others will probably have done fine. All right, S&P 500 index. Anybody know what the S&P 500 did yesterday? You got a 50-50 chance. Come on.
Party.
It what?
Oh, the party. It's a common thing.
It went down. It did go down. Actually went down quite a bit. Yeah, you had a 50-50 chance. Either went up or it went down.
And it's America, so it probably went down.
Well, lately, yeah, we've had a few issues. So anyway, the S&P 500 index, like the Dow Jones index, it's just a way, somebody a long time ago figured out, you know, it'd be nice if we had a way to just quickly gauge how the entire stock market did. So they created this index, which basically takes the largest 500 companies and looks at how all of them did, looks at how all their share prices did. Did they go up? Did they go down? So if 300 companies went up and 200 went down, well, the index is probably going to be up a little bit. So the index just gives you a really quick snapshot of how the market did as a whole on a day. Or we can also look at it over a longer period of time and see how the market does. So we've got, I took a few different date ranges just from 1929 through 2010, from 49 through 2010, etc., and then looked at what the annualized rate of return was. And the annualized rate of return was somewhere between 9 or as high as 11%. That's why I use those numbers when I run my calculations. Now I want to pause for a second here, because sometimes you don't see annualized rate of return and you see average rate of return. And there's a big difference there that needs to be explained. So if I have an investment that 1 year returns 100% and then next year returns negative 50%, what was my average rate of return? 25%? 50%? What else? 25. How do we figure out averages again? Yeah. So 100 plus negative 50 is 50 divided by 2. I should get 25%. So I averaged 25% per year, right? Yes? That sounds pretty good. Sounds like I had a really good rate of return, didn't I? I averaged 25% a year. But let's look at that. If I put $1,000 in and I earned 100% on it, how much money do I have? I'm up to $2,000. Now, I've got that $2,000 and it earns negative 50%. How much money do I have? I'm back down to 1,000. But I thought you said I earned 25% per year. Wasn't that my average rate of return?
Only had 1 year.
No, I had 2 years. I went up to 2,000 and I went back down to 1,000. The problem is really that the gains are not as big percentage-wise. It's a kind of a mathematical queer, I can't think of the word I'm looking for. Conundrum. Anyway, so an average